Thank you, everybody, for attending our third quarter review for 2021. Wow. Still pandemic stuff going on, but it seems like it's gotten a little better lately, which is nice. But we got started doing these with Apollo during the pandemic because a lot of people were a little bit nervous about what was going on in their portfolio. And in times like that, it's nice to bring in an expert and also just a second opinion on some of these things. So you're not just reliant on my take on things. And Apollo is the director of explaining stuff over there at Dimensional Fund Advisors. And he does a great job explaining a lot of the concepts that drive our investment strategy here at IFA. I have to say, I learned almost all of what I know about investing from the good folks over at Dimensional. And they have, I would say, the best people in the world helping guide their investment strategies. Eugene Fama in particular. There's a great article on our website. If you haven't seen it, it's called Fama One of a Kind, where we give a little history. We list all 108, 110 papers that Fama has written with links. You can go read them. And when people come to me with alternatives to our strategy, I like to tell them, hey, go read Fama One of a Kind, and let's compare resumes of who you're, wanting to listen to with Eugene Fama, because we're quite consistent with his strategy. If anything, we push it a little more small value than many people out there. But I like to, Apollo, just for your point of view, what I like to do is leverage and expose even a little bit more to the expertise that your firm has in trading these small and value and profitability firms. Because one thing that I've learned over the 23 years, it's not just an exposure to these that's important, it's the expertise in trading among those. I know you've talked more and more about this lately, is this sort of trading advantage. And maybe that'd be a great place to start. Maybe just talk a little bit about that trading advantage that Dimensional brings to the table in the implementation of your passive strategies around these factors.
Yeah, no, it's first of all, hi, Mark, and thank you again for the invitation, and thanks to everyone for attending and taking the time. So, that's actually a really important point, because a lot of the papers that you cite, there are public domain. Anybody can go and says, okay, I understand what they're doing. I understand the model. I understand the theory. And yet one of the things that is really important is not just the idea, but how do you execute it? How do you implement it in the real world? And one of the ways that that is brought to life is through trading. So let's just make it understandable. What do we mean by trading? One of the first pieces of research that came out of the academic universe that was really valuable to investors in the early 80s, late 70s, was this idea that small company stocks, when you look at the data, they tend to behave differently than large companies. And as you know, that they have what's called a premium. In other words, they deliver at a higher return to investors. And so as an owner of the asset class of small companies, I expect to have a higher return than large companies. And that's what Rolf Bonds and other researchers looked at in the US and international. And there's a pretty consistent message. There is a small company premium. But when this research came out in the late 70s, people knew about it. There was a problem, though. A lot of folks were saying that's great, that research is good and fine and dandy. The problem is that if you go and you try to bring it to life in the real world, you're going to get really killed trading these stocks, because as opposed to the large company stocks where there's so many buyers and sellers, and if you want to sell a stock, it's not that big of a problem to find a buyer, because it's something called liquidity. There's a lot of there are a lot of buyers and sellers, and that volume of trading, that liquidity makes it easy to transact. However, in small company stocks, some of these transaction costs can be very high. And one of the ways to think of a transaction cost is that if I bought a company, I bought a stock, and I bought it, let's say, just to make it very easy, I bought it at $10. I pay $10 for it. And a minute later, I want to basically say, hey, that's wrong idea. I want to sell it. Well, when you go and trade in the market, you're not going to get $10. You might get $9.50. So that is a trading cost. That's a spread, and those, that's called in jargon bid-ask spread. So for small companies, the bid-ask spread tends to be very large. For larger companies like the Apples, the Microsoft, it tends to be very small. So one of the things that the researchers pointed out is if you try to execute this in the real world, you're going to get killed trading because there's just not enough folks out there. There's not enough liquidity. And one of the things that David Booth, the founder of Dimension, and Rex Sinfield, the other co-founder, kind of what they brought to the table was this idea that we can do it. But the way to do it is, first of all, have a level of flexibility when it comes to holding. So not have an obsession with perfect weights. So if a company is supposed to be 0.2% and you have it at 0.22%, well, let's just not get crushed on that. Let's just go, okay, if there's a little variation there, that's fine. We can live with that. And the second thing is that we don't want to go out there and really demand the stock. We really want to buy this because that immediacy forces you to walk into a trade where it might be just not that advantageous. So what they came up with a system that in the early days really revolutionized in some way the trading. What they said was that we're going to look and perhaps at some instances, and this again back in the 80s, we're going to execute the trade, but instead of trying to take just a sliver, we're going to try to take a larger basket, perhaps from motivated seller, some active manager who really wanted to sell that position. And we're going to go and make them an offer they can refuse. We're going to take the entire position off their hands, but we're going to do it actually at a lower price because we are providing the liquidity to them. And that it was phenomenally successful because we're able to trade. And not only that we didn't get hurt trading, but it actually benefited us because we had that flexibility, and we might have had that position a little bit in a greater percentage that it was ideal, but the benefit really outweighed the cost. And over time, the idea of how do you trade became more and more important. Because again, in the world of a stock picker, having a stock really immediate right now, because that's my idea, I want to buy it, it forces you to go out there and say, I'm going to pay whatever just to get it now. If you want to get rid of it, I want to get rid of it, sell it whatever price it is. And that immediacy is horrific for a manager. On the other hand, you have the index funds, and they have no flexibility whatsoever. If the committee says you have to add this stock to the list, then the portfolio manager of that index fund has to add it on that day. Typically what you tend to see is that the price tends to go up just up until the date it gets added. When it gets added, there is that buy pressure, and then it drops off the price after it gets added to the list. So what we try to do is avoid both of these. We avoid the immediacy of an active manager. I want to get the stock today, but also not be tied to a list that is managed by a third party. And over the years, whether it was block trading, whether it's the dark pool trades, all of these things, actually not only that they didn't hurt in terms of implementing the strategy, but they added value. And again, you have to make it relative to what are the two other options, index or stock picking. And in both of those cases, I mean, there's so much data to show that you can add value to trading. Not only that you don't detract, but you can actually add value.
I like to think of it as patient trading, right?
Yep.
One of your guys, I can't remember who, I think Kenny talks about, Valentine's Days and roses, right? Everybody wants the roses on Valentine's Day. It's kind of like all the index firms, the what I'll call the traditional index firms, having to buy a security the day it's put into the Russell 2000, whatever. Right. And especially if it's a small cap firm and there's not a lot of liquidity, boom, there's going to be a huge drive in the price. Just as a reminder, I like to bring this chart up frequently to our clients. Here is this long-term data about small companies and value companies. And you see here that, over very long periods, 90, whatever, 3 years that is, the difference has been almost 2% a year, 1.94, with the small at 11.95 and the large companies coming in at 10%. And this is pervasive through time and through the world. These are two of the criteria that academics like to look at before they want to say that this is something, you know, that you want to put your money in, or that they want to write a paper about. They want pervasive differences over time and across markets. And so it's such a great reminder. In fact, we just had a question submitted about this small cap, really excess return from Kathleen. Kathleen says, gee, with all this shortage of supply and supply chain disruption, aren't those small companies going to get hammered, you know, in this environment? And is that something we want to own? She didn't actually go that far, but she was concerned about owning small caps in this environment. Maybe you could talk to the cost of capital of firms in risky times.
Yeah, no, and you know, it is something that it's unavoidable. I mean, Mark, anywhere you look, you open a paper or you read something online, this idea of supply chain disruptions comes up over and over and over again. And what it basically means is right now, you know, a lot of these companies have to figure out, how do I get my products to consumers? How do I build them? Because I might need 100 little parts for my products. And if I have 99, but not the last one, I still cannot deliver the product. So there are a lot of issues right now. And the question is, are these larger companies somehow a better position to withstand these supply chain disruptions than the smaller companies? And I don't know that I would make a blanket statement across all large companies or all small companies. I think there's a lot of diversity in the economy, but generally speaking, one thing that is becoming quite interesting, and you can observe, and it's part of the reason that you saw what Mark showed you, is that these smaller companies are perhaps a little bit more exposed to these supply chain disruptions. Does it mean they will go out of business? Some might, but I would argue that if you look historically, the vast majority of companies, small companies, they actually survive just fine. We had some data looking at the percentage of companies that go under, even in periods of high recession, like we had the financial crisis. And it's only about 5-10% maybe of the entire group of small companies that are publicly traded. So it's not that the vast majority of them go under. There are some for sure that go, but so are some of the large companies. But for sure, some of the small companies go under more. So is it possible that some of them might go under? It's possible, but we saw in the financial crisis that it's only about, you know, maybe 5% or maybe 10% of these these small companies go under. The vast majority, 90+%, they're going to continue to operate. So as an asset class, you're not likely to see you know, this disappear as an asset class because so many companies go under. But what it is interesting is, because they are more exposed to this to the supply chain disruptions, you know, as an investor, the way you want to think is that, well, they might present a little bit higher risk. And as an investor, for me to own these small companies, because it's a bit of a higher risk, I would like to get compensated more. It's almost like if you look at your FICO score, you have companies that have, you know, like individuals that have a FICO score, which, by the way, what is your credit score? Every one of us has a credit score. And if you have a very high credit score, I think it goes up to 850. So let's say you have an 840. The interest rate that you pay, because you're very low risk, you're very close to being a very safe bet in terms of being lent money, the interest rate is probably lower on your credit cards and other loans that you take. Now, if you have a much lower credit score, then you present a higher risk to that lender, and the interest rate that you pay has to be higher. So to the degree that these companies, the small companies, are more exposed to the supply chain disruptions, instead of thinking like, oh, this is really terrible for me as an investor, perhaps another way to think about it that presents an opportunity, because the cost of capital to attract investors into these smaller companies is higher. And as a holder into those companies, I will receive a higher expected return on my investment in small companies as a compensation for the additional uncertainty associated with supply chains or credit lines or track record, whatever the case might be. But again, that's not a terrible thing for an investor. That's where you get extra returns, higher expected returns, because you are willing to take this additional risk.
So let's validate that, Apollo. Here is the way we simulate past returns for large companies in the US. We call it SP, which is our version of the S&P 500. It's basically US large company. And then the blue represents small companies. And this is our last 50-year hypothetical backtested performance. And here you can see the gray line is the S&P and the blue line is small cap. Well, when things are bad, 73, 74, the blue line did much worse than the gray line. But look at what happened when things were good. The blue went way up. What you see is because the blue line is higher and lower, you have more volatility, more risk. The ultimate risk is the company goes out of business, by the way, which you mentioned, 5-10% going out of business. That scares people. But down here, you see the growth of a dollar, the compounded growth of your wealth over this same period. And generally, people say, hey, I don't want that risk. I don't want those concerns of getting a lower return in a bad period. But look at the reward. A dollar grew 270 versus 168 times. This is the multiplier of your dollar over that 50-year period. So you have to think about more risk, more return. But so someone says, well, why don't we buy just all small cap? Well, the answer of not wanting just small cap is it's kind of like Jack Nicholson, you can't handle that risk. A lot of people would have bombed out down here when things are down 40 or 50%. You're going, geez, I don't want this investment anymore. Well, that's what risk is. Or even when it's up 50%, then you're nervous. Man, I've had such a good run. Maybe I should get out of that investment. And so that's a problem. We call it concentration risk. There are a lot of issues. You want to have a diversified portfolio and not focus on just what has the highest historical return, partly because the reason it had that return is it had so much volatility.
Oh, great points, and it's also interesting that quite often, for some folks, it's possible to say, I really understand this. I really have my emotions in check, and maybe I do want to move towards value, because again, they do have spectacularly higher expected returns. When you look at the long growth of assets, small value relative to the large companies on the news, it's significantly better. The thing is, though, also that beyond what Mark said, if you add up the value of all these smaller companies, they amount to about 10% of the value of all companies in the US stock market. In other words, even though you have 1,000, 2,000 of these smaller companies, relative to their bigger cousins, they're not that big. So even if you add them to 2,000, they're only roughly about 10% of the value of all companies. So if you say, I want to put all the money in small companies, at that point, are you really ready to exclude 90% of the value of the stock market in the US? You could do that, but it's probably better to consider some. And secondly, when we, and this is something that's so important that we brought up over and over, but it's such an important point. When we're saying that that small companies or value outperforms growth, it's really important to know that we expect that to happen every day. The same way that I expect snow in Aspen in January every year. But I also know that it's not going to realize every year. There'll be a January when I show up and there's no snow, or Tahoe for that matter. That's fine. If you look at the data, what's so remarkable is that on an annual basis, if you look on an annual basis and ask how often does value beat growth, this is going back to the 20s, what you see is that roughly about 60% of the time. But what it means that 40% of the time, it's not there. And if I put all the money in value, 40% of the years, I'm going to be disappointed. Even if you go to 5 years, you move to 72, but almost 30% of the time, you're not going to have that in your back pocket. And even at 10 years, you improve your odds. So the longer you stay invested, the better. But even after 10 years, it's not 100% of the time. And it's very similar to small beating large. Over 1 year, it's 55%. Put the shoe on the other foot. It's 45% of the time you're not going to see it. So for that reason, I think it's actually important to diversify. And the way that I've always thought about this is it's a little bit like an ice cube tray. And if you think of an ice cube tray being the stock market, with every stock having the right proportion, that's a leveled ice cube tray.
Yep.
Now, what we're saying is, let's tilt a little bit that ice cube tray. Let's take some water from here, from large and growth, and distribute it down towards small and value, but not necessarily do this. And the degree to which you do it, as Mark said, you can do it to a little degree, a larger degree. But I think that flipping all the way and saying not have any large and any growth, I suppose you could do it. It's just, again, then you eliminate a big part of the market, and you're also going to run into many years when you will be disappointed. And that's when some folks might break the discipline and say, I've had enough of this. And if you look at the last year, the large tech stocks, which are part of large growth, typically, they've done really well. So having that as a class wasn't exactly terrible for investors.
Exactly. All right. So listen, we have a question that's been asked about 8 times on everybody's mind. And that is, what is going on with inflation? What the heck should we do? And I got ahead of you, Apollo. I brought up your favorite website. I already had it up there. And so Kathleen says again, Kathleen keeps coming back at us. What about inflation? What about this? Is this a bad time for me to be at this level of risk? Maybe I should change. So I've highlighted this little line down here. The latest value on this chart, this is what's called the 5-year break-even inflation rate, implies what the market participants expect inflation to be in the next 5 years on average. I want you to elaborate.
Yeah. So let's remember, because I think this is a really important chart. So I'm glad you brought it up. The idea of this chart is basically that when you think about inflation, there are 2 different schools of thought, 2 different narratives, 2 different scenarios that people are putting out there. In one scenario, you have a period of transition. When we go from a pandemic world to a post-pandemic world, that we have some issues on the supply chain, on shipping, on workers, but all of these are transitional. And as we get past the pandemic, then prices will come down, and we're going to resume the economy that we had before. And one of the examples that people are putting out there is that lumber, that when the pandemic hit, the sawmills thought that we're going to go through the same sort of economic slowdown as during the financial crisis. So they dropped, they stopped the production, thinking that nobody's going to want to buy it. Now, as construction kept going on, obviously, because the supply was now a lot, was not keeping up with the demand because they shut down the sawmills, the price of lumber started taking off, and it doubled or tripled during the pandemic. And as the sawmills realized, wait, they're buying lumber, let's go make it again. And they came back online, the price of lumber tumbled by about 2/3. So that's an example of one of the narratives that exist out there, that inflation might go up, but then as the economy reopens, as we go back to normal, the prices are gonna come back down. That's one scenario. There are another group of folks who are saying, no, this is going to last a lot longer. Some of these issues are structural. We have supply chain issues that might last a lot longer. Companies are getting used to passing increases to consumers. You have workers who now demand higher wages because, it seems like it's kind of harder to find folks. And all of this is going to lead to a longer lasting, higher inflation than we've had in the past. And I think that what the chart that Mark is showing is a referendum. It's a referendum that happens every single day. And the way you vote for this referendum is with billions and billions and billions of dollars. And you kind of say, I don't know what's going to happen. By the way, nobody knows. I don't know. Mark doesn't know. The Fed chairman doesn't know. The president of the United States doesn't know which scenarios will play out. But this referendum, it's showing you how investors voted billions of dollars. And this break-even rate is basically a reflection of a type of bonds that are linked to inflation. So their value goes up as the inflation goes higher, their value goes higher. Those are called inflation-protected securities, and they're issued by the US government. And then some bonds that are just not, they just have an interest rate that stays the same irrespective of inflation. So the value doesn't change with inflation. Those are called nominal bonds. So when you look at the difference between these, between the yields, you can infer what is the market signal on what they expect inflation to be. That's exactly what the break-even rate shows you. On average, over the next 5 years, what do market participants expect? And they vote by investing billions of dollars, and the way they price these bonds sends that signal. So what's fascinating about this, Mark, is that at the beginning of the year, it was about 2%. This is back in January, roughly about 2% expected inflation, which is the Fed's target. Now, as the economy reopened, it started moving up, and it hit a high of about 2.72 in May. And that was one of the highest points over the spring summer. And then shortly after that, within a few weeks, it dropped to about 2.3, because every single day in this referendum, the market participants are paying attention to the news. They're paying attention to supply chains and stimulus and all the things that you hear about. And what happened is, after dropping over the past few weeks, it climbed. And in fact, over the last 2 or 3 days, it had a pretty steep climb, where today's at 2.94, which is what Mark highlighted. Now, how should you think about this? It seems like scary. It went up from 2.3 to about 2.9. First of all, the fact that it went up about 0.5%, it's not exactly horrific. It's not like it went from like 2% to 8%. Secondly, you think about the Fed's target being 2%, and that's one metric. But you also have to look at the long-term average inflation in the US. By how much did prices go up on average over the long run? And the Matrix book, the good old Matrix book that we talk so much about, I love this book. And in the Matrix book, when you look at the numbers, what you see is that on average, prices in the US have gone up about 3% per year. So even after this spike, we're still below the long-term average in the US. The thing is, Mark, if you look at that chart and you extend it back to the beginning, and this is something that you can see here. If you extend it back to the beginning of the series, what it is, and this is the max that we go back. There are plenty of years and periods in the past when it was very similar to what it is today. It is not that unusual where we are today. So I think that part of what we have to just kind of just realize a little bit is that, yes, inflation will be higher. That's something that it appears to be the case, that inflation will be higher, but not in a panic zone, not where we used to be. Is it possible that it will go in that direction? Yes. Is it possible that it will drop? Yes. Which one will play out? Mark, I can have a half-hour talk on each and blow your mind of like the reasons why each one will happen. It's just that we don't know. But the market signal is the one that incorporates both of these opinions and thoughts into a market signal that is, to me, is the best way to think about it. It's to me that markets are probably the place to look. Otherwise, it just becomes a personal opinion, and I don't like personal opinions over the market.
You know what they say about opinions? We all have one,
Yeah. But, listen, there are folks, and I don't, Mark, you and I are probably too young to remember the 70s, right?
Speak for yourself, but go ahead.
No, I think you must have been like a young boy by then. Maybe you do remember, but, 1970s is in our lifetime and our parents' lifetime, the only period when we saw, just higher than normal inflation.
Yes.
And let's just disavow one concept. There's so many folks who are talking about runaway inflation, or another word called hyperinflation. And just from an economic definition, hyperinflation means 50% price increase per month. This country has never experienced hyperinflation. In fact, in the world, there may be 2 or 3 countries that have ever experienced hyperinflation. So when I hear that word, I cringe, because the highest inflation that we've seen in this country was in the 70s. And it was about 10%, 12% in the early 70s. And it kind of stayed that way through the late 70s. But the conditions were very different than we have today. There might be some similarities, but Mark, if you mind, I mean, there's a great, great lesson of how we should think about inflation. One of the questions that came, you remember in the Q&A, have you seen the questions that were posted by folks beforehand? Because one of them had to do with, what if the dollar loses its value? What if we just go into a situation where this, might not be worth anything to hold dollars? You remember that question? It was something along those lines.
Yeah. Where was it? Yep, the impact of the dollar. Go ahead. Yes.
Well, I want to think of something that again, it kind of stuck with me a little bit, going back to my economics days. For the longest time in history, the way that a currency worked is it was tied to a precious metal. Gold. Gold was chosen as being the metal that it had to back up any dollar bill. In other words, for the U.S. government to print a dollar bill, it had to have some gold to back it up. And that's something that we know as the gold standard. Yep. So the gold standard existed for many, many, many years. I mean, I can't even forever. There's a great book called Money that kind of looks at the history of money. But the gold standard ran into a problem, is that the economy couldn't grow. You couldn't print enough dollar bills unless you had the gold. So it's kind of hamstrung. The economy was hamstrung because there are not enough dollar bills for the people that were growing in this country, for the economic growth. So in 1971, the U.S. and the Nixon administration took a very brave step, and they said that we're going to cut the link between dollar bills and gold. Yep. So think about this. This is 1971. This is when we saw this happening. So think about this. The government kind of cuts this link, and if you are a citizen of the United States, and you hear on the news that right now the U.S. government can print dollar bills at will with nobody to keep it in check, there's nothing to keep it in check, what was your first thought? What would be your first thought? Oh my gosh, this is the end of it. The dollar's going to have no value because it's just a piece of paper backed up by nothing. The way that people thought about it was, I wouldn't say hysterical, but put yourself in the shoes of your parents who heard that news, that right now the government can print money at will because is not backed up by gold. That was scary. And what happened was the government put a wage and price freeze in place, meaning that you couldn't increase prices, you couldn't increase wages, and it was supposed to be for 90 days. But guess what? It did not last 90 days. It actually lasted about a year and a half. And it wasn't until 1973 when this ended. So picture this. You got a year and a half of compressed and artificially low wages, artificially low prices, where the market couldn't do their job. What do you think happened to those prices in early 1973? Take a wild guess. Of course they go up, because they're springing back up to where they should have been. But because of these increases, because of these wage and price freezes, the market couldn't function properly. And then you lay on top of that the fact that we had an energy crisis with OPEC deciding not to export oil to the U.S. And that compounded everything. Everything got worse, and there was a drought and food shortages. So it was like a perfect storm that happened in the 70s when we saw that high inflation. So again, when I look at this, I'd be careful, because when we're saying I think the dollar is going to be worthless, how would you have felt if you're transported back in 1971. And all of a sudden you see that dollars can be printed at will with no gold backing. You would have been really panicked at that point. And, we got through that.
Yep.
So anyway, so I'm optimistic. And, even this supply chain issue that you hear so much about, Mark, my perspective is that back in 1973, when that embargo hit, it was hard on this country. Yeah. But what it did, it forced us to rethink something. And we went and we started to become more energy independent. And it was a policy because we adjusted as a country. I think the same thing is going to happen right now. You look at the supply chains and say, they're not working very well. It's not these companies are full of idiots and folks that don't know what they're doing. They're just going to be like, okay, how do we fix this? How do we make sure that we learn from this? And maybe going forward, what it means is it's just a reemergence of U.S. manufacturing. Maybe it's a reemerging of the reemergence of the U.S. economy, the same way that we shifted gears back in 1970. So I'm actually very optimistic about what this all means for the U.S. going forward.
Isn't that what capitalism does?
Exactly right.
Exactly right. The market's needs, and those who serve the need of the market, get the rewards. Okay, I got a question here. Someone brought up that whenever I talk about market premiums, I should also talk about risk. Well, I just want to remind, I think it was Fred, right here on this chart, we show you one measure of risk, which is the standard deviation of these different returns and the standard deviation of the excess return. So the premium standard deviation, very important that you understand that. And now that you brought that up, this is a little shorter time period, but one of the interesting things about this new factor, we've been talking about profitability, it has a lower standard deviation. Now, I'll just remind you that this data is much shorter because of the availability of gross profit and asset financial information about companies, which is needed to calculate profitability. But in fact, I added this, I don't know, 9 months ago, year or maybe a couple of years ago now, I guess, so that there was a measure of risk to go along with it. But you should appreciate that all of that is built in when we design index portfolios for clients, because it's all about the risk here. You can see this continuum of risk and return. And when you answer your questions in the risk capacity survey and come up with a 65 score, it directs you to this portfolio that has had a standard deviation, again, one measure of risk of 10.63. So basically what I'm telling you is when you answer those questions, we give a different weight to different answers, and we roll them all up together and basically say a 10.63 risk is appropriate for you. Okay, so Apollo, is there some more sort of prepared remarks you want to talk about relative to this quarter? You usually have a few slides. By the way, where do you come up with all these newspaper headlines and pictures of the people waiting in gas lines? How many images you got there?
I have no life. All I do is sift through. I have a collection of. I love kind of looking and trying to get some perspective, because quite often you see the reality that's kind of staring us in the face, and kind of pulling back and see, how was the world at some point, and can we learn something? What's similar, what's different, and what does it mean for us today? I think it's to me it's a very valuable exercise. But I love history. I love learning new things, and to me that I'm just fascinated by that. There's more where they came from. So, in terms of the market, so quick overview. We're just gonna quickly touch on it. The markets for last quarter. We try to do this every quarter. Just how do the markets do? On the stock market, they were pretty flat in the U.S. In fact, when you look at the stock market in the U.S. as a whole, the 3,000 companies that encompass the Russell 3000, they were pretty flat, but basically no growth, no return. It was a 0% return or so for the quarter. Year to date, it's still positive. It's still a good number. International developed and emerging, what's interesting is they didn't quite keep up with the US. But Mark, one of the things that I wanted to bring up, because it is important, is to realize that when you look at international markets, whether it's emerging markets or international developed, what you see on your statement is not necessarily a reflection of how that stock market did. So let's just make it a real example. When you look at Japanese stock market and you say, well, the Japanese stock market did, let's say, I'm just going to toss a number of 5%. So the Japanese market did 5%. And that reflects how it did for investors in Tokyo who used their yen to buy shares of ownership in those companies. In other words, the local market in the local currency. What we have to do as U.S. investors is take that market return, the performance of the Japanese market, but then convert it back into U.S. dollars and show you that return after it was converted in U.S. dollars. And in that respect, the performance of the dollar relative to the yen is really important to investors. And what we saw is that over the course of this last quarter, the US dollar got stronger relative to international currencies, which is really good if you're a traveler. If you go to Tokyo and you get more yen for your dollar, that's great. Problem is it's good for travelers, but it's bad for investors. Because if there was, this is illustration only, not the real numbers, but if you look at the Japanese market and it was up 5%, for example, when the dollar gets stronger, that 5% might become 3% on your statement. So you see a lower return on your statement than you did in the local market. And the reason I bring this is that roughly speaking, for the third quarter, the US dollar got stronger, and the impact of currency on international markets was, again, broadly speaking, about 2% on the downside. So the markets abroad did about 2% better than you saw on the statement. And the reason that you didn't see the higher number is because of the dollar getting stronger. There are tons of periods when it works the other way, when the local market is 5%, but the dollar is now weaker relative to the Japanese yen. And on your statement, you might see 7%, which is more than that. So it's a seesaw. There's no rhyme or reason. So you have to know that at times the dollar movements help you, at times they hurt you. This particular quarter, it wasn't that international markets did horrific. It's just that there was an impact of currency because the dollar got stronger. So that's the first comment, that it's important for people to know that there is that. And I always want to caution, there are times when you really benefit, but there are times when you might not. Exactly. The second point I want to kind of talk about is something that you, Mark, speak of so often, which is how random it is from quarter to quarter, and you shouldn't get too attached to any one quarter.
What we like to do is we like to set the order of the highest return for the previous quarter. So quarter two in this case, in which we saw global Reits of all things. You know, a lot of people say, oh, people aren't even going back to the office. Well, here in one quarter, they had a 10.5% return. But be careful, you can't buy yesterday's returns, because if you loaded up on those, you ended up minus 0.4 in the third quarter, the quarter we're talking about now. And emerging market small caps, boy, that looked like a big winner. Everybody wanted to load up on that. -4 in this quarter. So this is one of my new favorite lines. You can't buy yesterday's returns, and you can't avoid yesterday's losses either. I guess they go hand in hand. But you just see here the complete randomness from one period to the next if we keep them in order of their performance from the previous quarter. I mean, here's emerging markets up 5%, minus 6.82 in this quarter. So, all right. So I'll cut that off and you can put yours up.
I love that line. You can't buy it yesterday. I love that line.
Yeah, thanks.
Yeah, it's whatever it is, it's in the past. I'm just going to add one quick quick note of that is just to kind of highlight the importance of being diversified, like you have it in your portfolio, and staying disciplined. If you look at the second quarter, the best performing market in the world by far was Brazil. Even though they had a lot of issues, and it was the best performing market in the world among everybody. And when you look at this quarter, it just happened that Brazil was the worst performing stock market in the world. It went from the best to the worst. And even among international developed, what's fascinating is last quarter, Japan was pretty much at the bottom, one of the worst performing stock markets. This quarter was second best after Austria. So that's why it's so crucial to diversify globally and stay disciplined, because from one quarter to another, it is so random. And to go from the best to the worst and the worst to the best, the only way to make sure you capture the best is to make sure you have them all.
Exactly. And yeah, it's the old needle in the haystack thing, you know, just buy the haystack instead of trying to find the needle.
Correct.
So we had one other question. Boy, I can't even believe we're already running out of time. I think we could do these for like 3 hours, Paul, just answering questions from people. Somebody did say you're on fire today. I agree, by the way. That was Aaron. Someone asked a question when they signed up about venture capital. You know, maybe this is a good time to get into venture capital. And Apollo, you had some data on that. Why don't you speak first, and then I'll show my slide.
Right. So venture capital basically means that you're going to put some money into some private companies that are not part of the public universe. And the difference is that these smaller companies, as they get started and they get bigger and bigger, eventually might decide to go public and open up their ownership to everybody. And when that happens, there tends to be a big payout to the folks who are already owners into that company. Not always, but you know, sometimes it happens that these IPOs, initial public offerings, they tend to have this mantra that they make investors a lot of money. It's not only the case, but it's possible that some do. So the question is, do you want to participate in these venture capital and fund some of these firms on the way to becoming larger and larger? And venture capital, there's a lot of money to be made, because you hear the stories of, I put money into Instagram before it became so big, and you put money into one company or another, or whatever it is. And there is a lot of interest out there. So how do you think about that? Well, the first thing that I would say is that you are buying ownership into a company. And that particular company, at that point, it doesn't have the disclosure requirements. It doesn't have the transparency of a publicly traded stock. So there's additional risk associated with that, tremendous additional risk, because you have no idea what you're putting money into. It's not a proven model. A lot of times you get started, but those companies, they tend to be unprofitable. And whether or not they make it, I don't know. The statistics that you hear out there is that when investors put money in venture capital, they expect that about 8 out of 10 companies will go under eventually, and only 1 or 2 are going to make them enough money. That's the first thing. The second thing is that if you look at the idea, you ought to expect a higher return from these venture capital, because they lack transparency, they lack track record, and that is something that it's not always in data. When researchers looked at the venture capital, they realized that by the time you account for the manager fees, by the time you account for all these transactions, you end up with pretty much a market return, plus maybe a little bit of a premium, but not that much more. So investing in venture capital through funds, it doesn't appear to be, the way to go. Some might do really well, but not all. And I know Mark has a great great quote there.
Yeah, so let me just add to that, Apollo. So the Kaufman Foundation is a very large private foundation out of Kansas, founded by Marion Kaufman. And they have been doing venture capital investments for how many years? What does it say here? I don't know, many, many years. And so they've decided to go back and look at all their venture capital investments, nearly 100 venture capital funds that they invested in. And here's what they found out in looking through their results. 62 out of 100 failed to exceed returns available in public markets after fees and carry paid. So what's a carry cost? So you pay 2% typically and 20% of the gain. Only 4 of the 30 venture capital funds that we committed capital to, over $400 million, delivered returns better than those available from publicly traded small cap common stock index. They're probably comparing to your index.
Right, probably.
And you think about it, that's what they're investing in. Venture capital, let's invest in those small cap companies, right? But as Apollo said, many of them don't make it. There are all kinds of problems. But probably the single biggest problem is the 2% fee and 20% of the gain that you give up. I often tell people, if you want to make money in venture capital or even in private equity, if you want to make money in these funds, start one.
Yeah, you pick up the 2% and the 20. But Mark, let's just. That's right. But let me kind of make one more comment. You hear about venture capital, and it's basically putting money into a private entity that is not part of the stock market yet. It's still a startup type of company. My feeling is that if you have something to bring to the table, you have a competitive advantage because you know something about a particular industry or device, and you get at the ground level because you understand. It's very different than giving your money blindly to somebody and just say, see what you can do with it. I have a good friend who basically was at Cedars-Sinai at the time when they were developing the stent, and he knew the doctor who was developing the stent or something of that. I forgot exactly what device, but it was a really important device. And he understood and he knew about the research. He was intimately familiar. There was a private company and he was allowed to put money in. Well, at that point, I wouldn't say that's a silly idea because you have a competitive advantage. You know something that other people don't. If you participate in real estate and you know something about a property that other people don't, that's fine. Most people look, Mark, I don't know what your assets are, but I know that one of the big ones that you have is a venture capital that you started, Index Fund Advisors. That is a venture capital because you put to work the knowledge and the experience that you have. So if you have that, that's awesome. But that means that you are involved. You're not just passing on the money. And obviously there's risk involved, but venture capital.
Human capital. It's human capital.
That's exactly right. If you put it to work and you have a competitive advantage, do it. That's how you make a lot of money. You start your own company, and that's great. That's great. I'm not going to discourage. That's the basis of capitalism. Start a company, but don't just give your money to somebody's hoping that they're going to find me a company that nobody else knows about. Yeah, that's not exactly right. And the last point, Mark. If you think of small companies, they're about 10% in the US of all the companies. So if you think that these are publicly traded companies or large companies, even the small ones, they're much larger relative to these venture capital. And then that's 10% of the US. The US is about half, let's say 60% of a global portfolio. So what you would have in the entire US small company universe, 2,000 companies, it's about 5%. If you put money in bonds, you even have less than that. So if you now think about venture capital, how much are these companies worth it? How much are they worth relative to, let's say, small companies? A tiny fraction, tiny itsy bitsy fraction. So how much do you want to put in venture capital?
Allocate,
0.5% of your money, 0.25%. That's going to make no difference. Nothing that you put at 0.25% is going to make any difference to you. And then, so ultimately, I don't really know that you need that unless you are involved, unless you start your business, unless you bring something to the table, your human capital, your experience. And in that case, you have my blessing.
Exactly.
You need that.
But also, if you really want risky investments, this is what you're in essence saying. When you're saying there's high returns there, you're also saying there's an enormous risk. You have to acknowledge this. People just don't want to think about the risk side of things. And so, if small caps equal the returns of venture capital, so here's small cap companies, for 50 years, 12% return. Well, gee, why don't we just buy some emerging market small cap? Let's load up on that risk. It's like 15, 16%. Maybe I think we have closer to 40 years of emerging market data. It's still at 16%.
Right.
And so to me, it makes far more sense to just put some emerging markets small in value. And that's what we do for you when we design your portfolio. And if you looked at the companies that are in there, you don't know any of them. And they're basically like a big venture capital portfolio. So don't worry about it. You're not missing out on anything. Just get your properly diversified, globally designed portfolio we put together here at IFA. And if you buy, hold, rebalance that thing, I don't think you're going to see any of your buddies or any of your friends do better than what you end up doing over very long periods of time. I'm just looking at some other comments coming in here. I see I'm getting some help from Chris answering some of these questions. One thing I noticed is that we have our multi-period return that we show on our website. It got locked down about 3 days ago because Dimensional did a swap of one large value fund for another. And I think that didn't get corrected in our program where we pull our data from Morningstar. In my opinion, you don't have to answer or give an expression on this. The reason they consolidated these two large value funds is they're prepping to convert that into an ETF, because this is the last tax managed fund that Dimensional still has that they have not converted to an ETF yet. So we'll watch for that in the future. Oh, there's one topic we didn't cover. I guess we're just going to have to talk about this for a while. And that's that good old Bitcoin. Let's talk about cryptocurrency for a little bit. And is it a currency or is it a commodity? I don't know now, because you get taxed on the capital gain all of a sudden. That's a big whoops. If your crypto went up and now you're going to go buy a Tesla with it. Of course, you can't do that anymore. But who knows? Elon might change his mind. Well, all of a sudden, if your crypto went up 50%, you go buy that car. The IRS wants a piece of that gain. Go ahead, Apollo.
So it's such a fascinating topic because, Mark, we talked about this, and when the Bitcoin was at 60,000, and we're kind of suggesting, I'm not exactly sure that's the right thing. We probably look like heroes because as he went down to 40,000, it's like people are, wow, these guys are smart. They kind of allow me to save some losses, avoid some losses. And then as he went from 40,000 back to whatever it is, 60 plus, now they're like, wait a second. So what's going on there, and how should you think about this? Are you guys heroes one day and not so smart the next day? So how do you think about
zero? It's hero to zero.
0 to 0. So this is let's go back to 2008, 2009, and back in those days, the idea of electronic money was nothing new. This is when Bitcoin started, but the idea of electronic currency and electronic cash was nothing new. And in fact, I would argue that, Mark, you and I have been using that way before Bitcoin. I happen to fly a lot, and when I fly, I get miles. And those miles get put into my account. Well, that is a form of electronic currency. They don't exist except for the American Airlines account or Delta or United, whatever I have. And that's electronic currency. When you go put money onto your Starbucks card, that's electronic money. So the idea of electronic money is nothing new. But what that system did back in 2009, when it was put out there, it was a short paper, 8 pages, put up anonymously by who knows who. And what they did is they kind of said, okay, we're going to try to make an electronic currency that is universal rather than just for Starbucks or American Airlines. We're going to make it that you can use it across everything. But that wasn't really the brilliant idea that was brought to the table. What they said is that right now, if you look at the way that we keep track of who owns what, there is a centralized ledger. So when you go to the bank, you have a bank account, the bank has a centralized ledger that keeps track of how much does everybody own in their accounts? And that's centralized. What they suggested was a different way of keeping track of assets. And it was a decentralized ledger. And in fact, instead of having one ledger, there are ledgers on thousands of computers around the world, and they all have exactly the same transactions written up. And as a new transaction that one person transfer money to another, that transaction gets added to the ledger as another piece in the chain. And that system was named blockchain. And Bitcoin is an application of a currency on top of the blockchain. And I want to separate blockchain technology from Bitcoin itself, because I think a Bitcoin is one application. And because it's just one application, you have thousands of other currencies like Bitcoin. You have Ethereum, you have Dogecoin, you name it, they're the stable coin. All of these are kind of, similar ideas that live on top of the technology called blockchain. I do believe that blockchain has legs. Blockchain will continue to be part of the society and the world. I have no doubt about it. And this is my personal opinion. So I think that I want to separate the technology from Bitcoin. Now, you asked the question, is Bitcoin a currency? The answer, in my opinion, is unequivocally no. There are three features that a currency has to have. The first one is it has to be a store of value, meaning that what he can buy with it today is roughly the same what he could have bought last month, roughly the same that he can buy next month. With the fluctuations in value of Bitcoin, it is not a medium of exchange, is not stable. Second, it's a medium of exchange, meaning that you can use it to buy things. So to me, it is not a currency. It's not accepted. It doesn't have a store of value. Nothing gets quoted in that. So let's just make sure we understand it's not a currency. You cannot pay taxes in it. It's illegal in China and so in other parts of the world. So it's not a currency. It's not a currency. So then what is it? Is it an investment? It's an investment, but in a different way than stocks, bonds, and real estate, which is what we think of as investments. And why is that? Well, if you buy a stock, you own a piece of a company, an Apple, or you name it. And when you own a piece of Apple or Google, you kind of know, okay, this company has real people, real products, real profits. And when I buy ownership, I get to partake in those profits, in those earnings, into cash flows. And because I can sort of estimate, I can look forward and see, what do I expect to get as an owner in that company? I can value today those future cash flows. And that's the idea of valuation. I can value a stock by what I expect is going to happen. I can value a bond. I'm going to receive these interest payments. How much are they worth today? I can value that. If you buy a building, you collect rent, you can say, well, I can value this. And in that respect, you can say, okay, if I'm going to collect $1,000 a year in rent, paying $1 million for it today is not a good idea. It's just too expensive. So in terms of valuation, I have a sense of the valuation for stocks, bonds, and real estate. And that's what we're trying to do is look a little bit more critically at these investments. Bitcoin has nothing like that. It has no production value. It doesn't produce anything, and it's impossible to value, because the only reason that the way people value it is that, well, I think somebody's going to pay more for it in the future. Why? I have no idea. So because you cannot value, I cannot tell you that 6,000 or 60,000 is a good deal for Bitcoin. Nobody can tell you. It is more of a speculative commodity, if you want to think about it. It's a speculative thing that you own, that it might go up and might go down. And that begs the question, why do you want to own it? Why? And there are only a few reasons. One is that you have the dream of making a lot of money. And you also have to be careful all the money you could lose. But for some people, it says something about who they are. I'm avant-garde. I'm part of new technologies. For some people, it's entertainment. For some people, it's the fun of watching it. Whatever the reason might be, it might be valid. Do you know how many billions of dollars are being spent every year on lottery tickets? Hey, if you want to take your lottery ticket money and buy Bitcoin, I cannot say that's foolish. That might make sense. But think of it as more of a lottery ticket. It might pay off. It might not pay off. I think of it as, Mark, do you remember Beanie Babies?
Oh yeah, Ty Warner, the guy made
Ty
a
Warner.
fortune. In
Ty
fact, the
Warner.
hotel he built in Santa
In Santa
Barbara is the
Barbara.
one where we got married. Yeah, go
Yeah,
ahead.
Four Seasons, the Biltmore. That's right. Now, here's the thing. Back a while ago, I had a friend who was really into Beanie Babies, and she used to buy them and then resell them, and she made tons of money. And I was like, wow, it was easy money. And she was like, how can you not do this? Because you make tons of money. And I was always blown away. Where is the value of these Beanie Babies? Why are people paying so much for these, Beanie Babies?
Yeah.
And she loaded up closets of Beanie Babies, and she made money for a while. But at some point, that craze stopped.
Yep.
Stopped. And she was left with a bunch of Beanie Babies that nobody wanted to buy anymore. And to me, it kind of resembles a bit the Beanie Baby craze. It's possible that he can make a lot of money, but I don't know why. I don't get a sense why. So because of that,
Or
think of it more of, play money, lottery money.
So someone just asked, is this kind of the same with gold and silver? When anybody asks me about gold or silver, I like to bring up this long-term chart here. This is 43 years of all of our indexes and our whole portfolio data. Here's silver for the last 43 years. It's had a return of about 2.5 or 3%, which is inflation. And it has a volatility of 33. Okay. So that's what you're just talking about, some massive volatility in prices. And gold isn't a whole lot better. The return has been, maybe 4 or 5% in this period, but the volatility of that thing is like 20. And so people say about, adding these to smooth out your portfolio, hedge against inflation. It's nonsense. It would take your portfolio 100, your full equity portfolio, and drag it down over here somewhere, depending on how much of it you put in. So it's nonsense. By the way, we just got the ultimate compliment. Eric says his wife is trying to drag him out to lunch, but he's telling his wife, this is better than anything on Netflix.
Well, we should have a show on Netflix. You already have a movie on Amazon Prime, so why not have a show on Netflix? You and I.
There you go.
But we are holding people back from lunch, right?
We are holding back, including myself. My wife is texting me, what do you want for lunch? When are you going to finish this thing? Anyway, listen, Apollo, it's always a pleasure to have you. In fact, people are begging that we do it more often. No, you only get a certain amount. You have to hang around for the next quarter. Actually, we did stick one in about sustainable investing this last quarter. And so, listen, I was just about to wrap up, but I got to tell you real quick. I said my first client was one of the clients on here, just by initial GF. Anyway, turns out she wasn't the first client. I went to her house in 1998 to pitch this idea of starting IFA. Sitting over in the corner was her daughter, listening intently as I described it to her mother, right? And so when I got all done, the daughter runs up, she says, I'll sign up. And so forevermore and forever since, whenever we communicate, she's just number one.
That's awesome.
Lauren, thank you for being number one.
That's all right.
So really enjoy having all of you here. Enjoy this opportunity to go back and forth with Apollo. I hope you found it educational, and we will do it again next quarter, or if some topic comes up, sometimes we just hop on and do another one. Thanks for your time today, Apollo. We all really appreciate you sharing your immense wisdom about the markets in general and for how we should be investing our money.
It's always such fun. So thank you for having us, and everybody have a great weekend.
Yeah. All right. Thanks, everybody. Bye-bye.